And we are live. Hello, everybody out there, Facebook, tuning in. Back again here. Today is June the 1st, and I know, hard to believe, but today is also the day the stress test is kicking in. And we talked a little bit about that last week. I had a special guest on, Keisha Johnson, and she's actually back again today, so we can discuss that a little bit more, plus a few other things that'll come up, including credit scores, which are important to everybody. So without further ado, I'm going to bring in Keisha. Hey, Keisha, how are you?
Hello. Good afternoon. I'm doing awesome.
Excellent, excellent. So Keisha, June 1st, what's the significance of today? The stress test comes in, what's going to happen? Market going to crash, or what's going
Yes.
on?
Yeah, so the stress test definitely comes in. I mean, it's been all over, the media for quite some time now. We had a bit of a surprise last minute because it was for the uninsured, which was putting down anything more than 20%, or if you have more than 20% equity in the home. But they did a last minute implement there where it included the insured as well, which is 5% down, and of course, or anything under 20% down. So it affects first time home buyers, of course, those that are trying to get into the market. I wanted to point out that, remember, we've been there before, or we've been here before. Remember the stress test when it initially came out, it was actually higher. Through COVID, it's dipped to 4.79, and so
That's
today, we go back up to 5.25. Yes.
5.25%. And that applies to all mortgages, regardless of how much down payment you're putting down, right?
Exactly.
Yeah.
Exactly. Yeah, so it does apply. I mean, if we're putting it into numbers, we kind of covered this in our last broadcast with regards to, if let's say your purchasing values, I don't know, let's say 600,000, your income is about 120. What happens is that your income will now have to be about 125 to afford that same home. So, or your buying power dips, based
That's
on
correct.
that. Yeah.
So this makes pre-approvals all that more important, right? So people buying a house, I mean, I know there's a tendency there to drop conditions because it's so competitive out there, but I mean, we wouldn't be doing our jobs properly if we didn't warn people what the drawbacks of that would be, right? So what's your take on, dropping conditions, having pre-approvals, et cetera?
Yeah, I mean, my take is that you definitely have to setting the expectation with our clients, right? Because anything can happen, right? We're going to do our part with the best, with the knowledge that we know, to make sure that we are setting you up for success, right? When you are waiving the conditions, we have to keep in mind, we want to make sure with regards to the property values, if it comes in less, of course, than what you've overbid at, then if the appraisal doesn't come in, the lender's not, or come in at the right value, the lender's not going to move forward with the purchase price, so we have to keep things in mind.
Absolutely. And that's something that's sometimes overlooked, even by real estate agents, because I can speak to that as well. I actually had a client a few months back who overbid on something, and the appraisal came in. We were lucky enough to get the house, but the appraisal came in $100K less than what they were bidding for it. So thank goodness they had a mortgage broker who was able to fight for them, get a second appraisal, pull some strings, do what needed to be done in order to get close on that property, or close on that deal. I mean, the clients obviously had to ante up an extra $27,000, but that's why it's important that when you do put in a bid, that you do have some extra cash, right, to make up any shortfall that comes in from the appraisals.
Right. And we have to keep in mind as well that if your numbers are really, really tight, your finances are really, really tight, you may not have that bridge, to make up for that shortfall. So we really want to make sure that, we understand exactly what we're going into when we're kind of going back and forth in that bid-in type of cycle. Yeah.
100%. So, I mean, I think we can both agree that pre-approvals are good, but they're not the be all end all. They're not guaranteed by any means, right?
No, they're not. I mean, I always say pre-approval actually means nothing. I mean, 9 out of 10, it's not until the file goes live that the lenders are actually going through those files.
Right.
I'll give you an example. I had a client that actually was my client and went to the bank, got a pre-approval, took that pre-approval to a new build, and put a deposit on a property. Now it's time, the file is going live. They go back to that very same bank and, looking for the commitment. Guess what? It was not possible. Mind you, they got a pre-approval from that bank, right? But the numbers were so tight once they actually had a chance to look at all their documents and everything, it wasn't going to work. So, the client comes back to me now and they're, I'm like, what'd you guys do? And, I know, Keisha, but it was a pre-approval. I said, pre-approval means nothing. Luckily on the broker side, the lenders are a little bit more lenient. The numbers are, if they're tight, the ratios, in some cases, we're able to stretch the ratios out, and I was able to get them into their home. Right. So, these are things that we have to keep in mind, that when we do a pre-approval, we're going to do our best, internal pre-approval, based on what you're giving us. But once it goes in and the lender starts to really dissect, that's when everything goes live and we see the full approval. Yeah.
100%. And that's why I'll add in that it's so important and critical that one has a mortgage agent, or broker rather now, congratulations, such as yourself, who is willing to fight for their clients, right? And willing to make those calls, dig a little bit to make sure that they don't lose their deposit and they don't end up getting sued, right? It's so important. So that's great. Well, I'm glad to hear that. Excellent. So let's switch gears here a little bit because, when we're talking about pre-approvals and approvals, obviously a big part of that is one's credit score, right?
Yes.
So we look at income, we look at credit score. So tell us a little bit about credit score and how important that is.
Credit is very important. I always say it's the difference between you being put into a box and having options. Right. And you want to have options, especially in this market. You want to have as much options as possible, to make sure that you're getting the right product when you're purchasing a home. So, the first thing that I do when I know a client is serious, or if a client is serious about moving forward with the purchase, is pull their credit. All right. And oftentimes you'll get, clients that will say, are you going to pull my credit? Is it going to be a soft pull, a hard pull? I don't want my credit to dip. And I say, are you serious about moving forward? Are you ready to purchase a property? Yes, I do have to pull your credit.
Yeah, for sure. Okay, so what goes into the credit score?
Yes, well, actually, I do have a bit of a chart here. If you can pull it up, I'll kind of break down all the components. Yeah, that goes into the pie chart. Okay. So these are all the components that go into a pie chart, and of no surprise, payment history is the biggest one, right? It's huge, right? Because you buy something, you got to pay back that money. Right, it's borrowed money, and so 35%, of course, of this pie chart is what goes into the credit score. All right. Then we have amount owed, and sometimes people don't realize how huge this is as well. As you see, it's following payment history by not too far behind. Amount owed, that's your utilization. So let's use small numbers. If you have a credit limit of, let's say, 500, and you're sitting at your amount owed is let's say 450, 470. All right. Now you are over the midpoint. All right. So midpoint of 500 is 250. Anytime you're over that midpoint, your credit score is actually more prone to go down as opposed to going up. Right. So don't get me wrong. Make sure you're paying that minimum monthly payment. That's good. But you're sitting at 480 month after month, putting a minimum monthly payment, hardly knocking off any payment there based on the interest, right? So the lender actually looks at that as you're heavily dependent on your credit to survive, right? You want to bring that balance down as much as possible below that midpoint. I'll have clients where I pull their credit. They say, I don't know, my credit is stagnant. It's not really moving. And I'll see you have a limit of, let's say, 1,000 and you're sitting at 900. You've been sitting there, or a limit of 2,000. You're sitting at, 1,700. You're overextended on your credit, and this is definitely going to affect it.
100%. So is there a difference if someone pays the full balance every month versus somebody who, does the minimum payment, et cetera? Obviously you're going to pay more interest, but does it affect your credit score that way?
Yeah. So, I'll put a disclaimer out there. I'm not a credit credit specialist,
Sure.
but this is
Absolutely.
this is based on me putting things into place to help my clients so that they can get their credit in the right position. And even myself, when I present this, I'm very open and honest, where I have been in a bad credit situation. I have been in a bad credit situation, and I rebuilt myself, right? And so, based on that, I mean, with regards to whether you're paying it off completely or doing the minimum monthly payment, you could pay it off completely. The whole idea about credit really is to use it, right? So paying it off completely and just kind of leaving it there. Oh, my credit is this. Let me just pay it down, and it sits there. Nothing will happen. It won't start to move, right? You need to buy, buy, paid off.
Exactly.
Yeah.
No, that's great advice, right? Because then that's the only way to bump up your credit score is to use it, utilize it. Then the banks and the lenders and whoever sees that you're actually good at paying off your debts, right? You can, and they'll afford you even more credit, which is good, which also bumps up your credit score.
Exactly. And then we have length of credit history, which is big as well, right? Because your credit history is very important. It's a part of your credit score. And so if you have a credit card where, for some reason you decide maybe you're fed up, you want to cut it up and, close that credit card, especially if it's good credit history, when you close that credit card, that pulls that history out, and your credit score, it will affect it. All right. It will affect it. So, you want to try to, if it's good credit history, if you can avoid closing that credit card, then I would suggest that. And if sometimes you get an offer from the bank with regards to, upgrading your credit card, make sure you're not closing the existing credit card in order to do so. Always do that bit of research to find out, if I do accept this offer, will this credit card be closed for me to take advantage of this, or is this a complete new credit?
Right on. Okay, that's great advice, because some people have extra credit cards, which they say, okay, I'll just get rid of it, right? But that might actually hurt them. Wow.
Exactly.
Good
Yes.
Okay.
That can hurt, right? And we then have new credits. So this is when I'm pulling your credit, or anyone's pulling your credit, right? So the thing that we have to understand is that when you're purchasing a vehicle or purchasing a home, it's actually called smart shopping, right? Which is much different than when you're out there going to Best Buy, Leon's, the Bay. When you're smart shopping, you're allowed a certain amount of pulls within a month. And so what happens is that those pulls, mind you, I won't encourage, for you to go to this bank, that bank, this bank. I mean, find a good broker to work with so that, you have the best experience. But if it so happens that, this is what is happening, then keep in mind that what happens is that it's lumped together as one hit, as opposed to if you're going to Best Buy, Leon's, the Bay, each of those will be an individual hit for each time. Right. So you can imagine how it will kind of sink your credit score, every time you do that individual dip. So 10%, as you see, now, this is what I say when, clients say, are you going to pull my credit? Is going to be a hard or a soft pull? It's a minimal effect. It will to some degree, but once again, they lump it together as one hit for that month.
I see. And correct me if I'm wrong. I mean, a hit, even a hard hit, is not necessarily bad unless it comes without some kind of account opened up, right? So if there's a bunch, so if you're like rate shopping, for example, I want to try out all these different places, and then you don't end up opening the account, it may reflect badly on your credit score, because it looks like you've been denied for some reason or something like that. Right?
Yeah. Yeah. So you want to, you definitely want to keep on top of that. And then you have the type of credit, which is typically, especially if you're purchasing a home, lenders are looking for at least 2 trade lines, right? And then, you want to have at least a limit of 1,000 or 2,000. This is no comparison to a purchase value of, 700,000. But bottom line is, lenders want to see how you handle big money. All right.
Gotcha.
Yeah. So typically, what you want to have is, maybe 2 major credit cards, maybe a department store card. But the bottom line is you do want to have at least 2 major trade lines, 2 trade lines, so the lenders can, be able to assess your credit. You don't want the make or break to be that you only have 1 trade line. Then it kind of puts you more in a box. And this is basically setting yourself up, whether it be that you're purchasing a vehicle, you're purchasing a home, maybe you need a loan from the bank to build your business. You want to try to set yourself up, position your credit in the right place so you have an opportunity to take advantages and position yourself for the opportunities that are out there.
Excellent. Okay. So what would be a good credit score then? What do banks look for? What do lenders look for with respect to that?
Good. I'm glad you asked that question. Actually, if we go to the next slide, good credit score is considered as anywhere from 680 and up. All right. Now, when I say the difference between being put into a box and having options, here's a prime example. Now, CMHC, they made a bold decision a little bit into COVID to actually put their minimum beacon score to 680. Now, I don't know if you've ever heard that phrase where, they say if America sneezes, Canada catches a cold, right? Maybe you have heard
Let's hope it's not COVID. Yeah.
Yeah. Oh, yeah. Yeah. But typically, if CMHC makes a change, then the other insurers follow sync. But in this particular change, Genworth and Canada Guarantee actually did not follow sync, right? Which is good because, then everybody would have to make sure they have a credit score of 680 in order for the insurer to entertain your file. And so this is what's happened with CMHC. Unless at least one person on that file is 680, they will not look at the file, right? But so once again, let's just say that CMHC happens to have the product that you need for your purchase and Genworth doesn't, right? So could that be the make or break with regards to maybe, let's say they offer fully gifted and, Genworth doesn't, right? They both do. But, just to give you an example as to you don't want to be put into that box where because you don't have the best credit score to give you the options of all the insurers, right? You want to make sure that you have those options, right? So right. So good credit score, anything from 680 and up. Bruce credit is anything from 600 to 670. As you see, this may consist of some, late payments. Maybe a bankruptcy is in there as well. And then we have poor credit, which is on the borderline. It goes into private lending, and that's a whole, it's a different ball game. It does serve its purpose, but 600 and below can kind of tap into the private sector. Something to keep in mind as well. Now, no credit, new credit, or low beacon score. This could be someone who's new to the country, new to Canada, and so when you pull their credit, it looks, there's no credit. The trade line is very thin. There's two things here, though. The lender may read between the line here. It's either you're new to the country or maybe you filed for bankruptcy in the past and everything has purged over, because the lender may say, okay, you're 45 years old and you have no credit history at all. Everything is new. Right. Have you filed for bankruptcy before? They start to read. I'm not saying you do have cases where, the light bulb turns on at 45 and you decide, hey, credit is important.
Get your first credit card at 45. Yeah.
It happens, but for the most part, lenders are going to read between the line and try to do their due diligence with the bank too, if they want to lend.
Certainly.
Right.
Certainly. Yeah. Okay. Excellent. So, if you are in this situation, how do you improve your credit score? I'm sure there's ways to do that, right?
Yeah, certainly. So, go to the next slide. We'll kind of break down a few ways, of course. So, you want to dispute all your errors. That's the first thing. You can pull your credit report at least once every year free. Keep in mind, though, if you want your credit score, you do have to pay for it. And I do encourage you to definitely get your credit score. You're not going to know where you are and what you're trying to work towards if you don't know where you're starting at, right?
There are, sorry to interrupt you, but there are some, I guess, vehicles like Credit Karma, things like that, but they're not entirely accurate because they're free, right? So they're offering you free credit score, but it's better to go with a reputable company like Equifax or TransUnion to get accurate more and see what the banks see, right? Because you want to see what the lenders are looking at, right?
Right, and you're absolutely right with that, Lambros, because with Credit Karma and I think Burrow, so Credit Karma is TransUnion, and Burrow is Equifax. Okay. All right. So essentially, what's happened is that these companies have gone to these credit agencies, TransUnion and Equifax, and they're third-party agencies. They've basically bought your information, and they now have the privilege to market to you. So if you are registered with these sites, then you'll see that when you go and check your credit, there'll be offers, and you have to be very careful because sometimes these offers with regards to the interest rates are higher. There was a study actually done, not to, it serves its purpose, right? But there was a study done where they were noticing that some of the interest rates that those who had a credit score of, let's say, in the 750s, 800 were getting the same interest rate as those who had the credit score of like 500 or 600. you think that you'd get a better offer, so these are things to watch out for. But that's what they do, is they advertise. They have the privilege to advertise to you now on their platform. So you may see you qualify for this credit card at whatever interest rate, and you click on it, and so that's how they get paid, right? So when you click on that, that's how they make their money through that, right? It is free, it is convenient. Yeah. Right, but it's always good if you can to go straight to the source, which is which is TransUnion, of course,
and Equifax.
Yeah.
Excellent. Well, that's great. I didn't know that, so it's something to learn every day.
Yeah. Right, exactly. So so you want to dispute that, your errors, of course, as mentioned. No matter what's on there, even if it's an address and that's not your address, don't leave it there, because these are things that could affect your credit, right? It could be an address that's had past delinquencies, and that puts a stigma on your credit, right?
Oh, that's right.
Exactly.
Right. Yeah.
So you want to make sure if there's something on your report that does not belong there, make sure that you contact Equifax and you remove it. Right. Another thing to note as well is if you found yourself, in collections, it happens. Life does happen. But if you find yourself in collections, make sure that once you make a payment to pay off that debt with whatever arrangements that you've made, we can touch on that a little bit after too, with regards to how to, contact your debitors on your own. But you want to make sure, of course, that, you get information from them to confirm that you've paid off those debts, right? Don't leave it to them to report for you. Get the document yourself. You send it to Equifax, right? Because someone could drop the ball. All right. 100%. You have to take responsibility for your own. So check your limits and stay within it. Hey, if your limit is 500, when I pull your credit, I shouldn't see 505. That's a snapshot frozen picture of what I'm now going to send to the lender. And they're going to see that, hold on, your limit is 500 or your limit is 1,000, but I see you're even $1 over it. Like you want to make sure, because that shows your responsibility. You're not going beyond what you've been given. Yeah, right?
100%.
So you want to definitely take a look at that. And then, try to negotiate. Hey, if you have been paying your credit card, for years on time and something happens, get on the phone, contact that debitor. Sometimes they don't even report to the credit agencies until 30 days after. So give it a try. Call, listen, this is what happened. You look at my report, you see I've never had an issue before. I'll get that money to you by the end of the day. Please do not report to the credit agency, because guess what? Once it goes to the credit agency, that's on your report for 7 years, even if it's 1 month past.
And it's harder to remove it afterwards as well, right?
Right. So yeah.
I'm really glad you brought that up, because a lot of people don't realize that they can negotiate with these creditor or debtors. Yeah.
It's worth a try. What's going to happen is either they're going to say, sorry, it's already sent off, or sorry, hey, but you're not going to know unless you get on that call and try to negotiate, right? Right. So you raise your limits as well, raise your credit card limit as well where possible. Like, let's just say when I touched on that limit of, 500 and you're sitting at a balance of, 480, but you've been paying on your minimum monthly payments. You've been keeping up, right? You've had your good strides as well. And, lender notices that, and they send you out a offer to increase that limit. All right. So remember, we spoke about that midpoint of 500 would have been 250. Now, if you're overextended at 480, almost maxed out at 500, and you now have a golden opportunity to increase that limit to 1,000, guess what? What do you think is going to happen, Lambros? Are you below that midpoint?
Well, of course, you are now. So I mean, it's on the one hand, this is great, because now you're below the midpoint and you've got all this. You reduce the amount of credit that you're using, so that helps your credit score. But the trap that some people may fall into, I'm thinking, is that, oh, now I've got this extra credit limit, I'm going to start spending more, right? So they're going to, and I think maybe lenders and the credit card companies are hoping for that, because now they're getting even more out of you. So we have to be very careful when you are increasing your credit limit. Do it, but don't abuse it, right?
Exactly, because that's exactly what could happen. If you know yourself and you know very well that you're going to increase it to 1,000 and not far behind, you're going to rack yourself up to around 980, then you may need to take a step back and say, you know what, appreciate the offer. You're going to just pay off what you have already.
Yes.
And exactly, because you could very well put yourself into a worse position. Now you're owing 800, right? So you're absolutely right on that, Lambert.
So it's going to take a lot of discipline. So
exactly.
I would suggest maybe accept the offer, but then forget about it. Don't even still think
Yes.
that you only have that $500 limit there, right?
Exactly, and pay it down, right? Exactly. So, change the type of credit that you use as well. If you have an opportunity, of course, to take advantage of a line of credit responsibly, then of course, definitely I say to go for it. And once again, I pine on that responsibly because, as we were just talking, you can definitely put yourself in a worse position. So you know yourself better than anyone else, right? It's about building your credit and building, your position so that you can take advantage of opportunities. Yeah.
Excellent. Okay. Well, this is great. I mean, so how do people get in touch with the credit companies and TransUnion and Equifax, et cetera? I think you've got some phone numbers here.
Yeah, sure. So yeah, definitely you can. Yeah. So this is Equifax and TransUnion. Now I will say I'm kind of old fashioned, and when I pull my credit with Equifax, I call. It goes into an automated system that asks, for your credit card. I enter my credit card information, and then it asks if I'll be using this credit card to pay for the credit score because I choose the credit score option.
I
see. Yeah, so it's snail mail. I'm okay with it. I think it's about $11.99, and you get it in the mail, right? Of course, there's quicker ways to do it, or it could be online. With regards to, you may have to maybe a subscription. I haven't done it online, to be quite honest with you, for a long time. But I don't know the exact cost, but I know it's more than $11.99. So. Right. So, but it's fast and it's convenient, right? So that's something to consider. Now, I do want you to keep in mind that when it comes to Equifax and TransUnion, what one has, one may not have. And when I say that, I mean that all credit agencies reports to both of them. All right. So you do want to pull both of them at least once a year. There's nothing worse than pulling your credit. You're excited, you're ready to purchase a home. You finally decide to pull your credit, and something's on your report that's not me. Right. So now we have to scale back and try to figure out who is that, because when you submit that to the lender, they're not going to buy. That's not me. So we want to make sure that we pull our credit, we stay on top of it at least once a year, both of them, so you're able to, keep on top of both of them. I've had files where Equifax for our industry is typically what is used, but I've had files where the lender, because it's so tight, the finances are so tight, the credit is not the best, that they decide to pull TransUnion. And if there's something on TransUnion that is not in their favor, then it's not going to go through. Fortunately, it was fine, but it's to, prepare yourself to make sure that you're taking care of all angles, make sure everything is covered. Yeah.
Gotcha. So lenders don't have a preference one over the other, right? It just depends on.
No, Equifax is traditionally what the mortgage industry uses. Typically, TransUnion is car dealerships, furniture stores, stuff like that. But predominantly, Equifax is what we use in the industry. Yes.
Gotcha. Excellent. Well, that was great. Thank you for that. Very informative. I learned something. That's great.
Actually, you know what? I wanted to point out too that there are many different types of credit scores, right? And in fact, there's a credit score called Beacon 9.0, which came into effect, I believe it was 2016. And in that credit score, it included your cell phone bills and your mortgage. Now, it was always on the report, but it was not included in the score. And I kid you not, that when it was reported in the score that those who were paying their cell phone bills, their credit increased. And those who weren't, because cell phone will dip you, right? A small bill, but believe me, I can't tell you how many times I see Rogers and Bell late payments, right? And in that time span, it dipped because these people were not paying their cell phone.
That's right. And those are easy to fall behind on. And I've talked to a lot of people. The majority of disputes that I've heard are with cell phone companies, right? Be it, Bell, Rogers, TELUS, whoever, right? So everyone has an issue with them. They said, "Oh, here's my credit score. It's only bad because of this phone company that screws me." I say that all the time.
I hear that. It's true. It's a common thing as well. And also, they do have a report that actually detects the likelihood of you filing for bankruptcy. So that is how, and if they want to pull it, they can pull it as well. So this is how detailed you're tracked. Your daily, routines when it comes to spending and all that type of stuff. So definitely you want to make sure that you stay on top of your credit. Yeah.
Interesting. Well, that's fantastic. So, so how can people get in touch with you?
Yeah, definitely. You can definitely contact me. You'll see it right there on the screen, KJ at rtsmortgagefinancial.com. You can give me a
Perfect.
call, 647-580-7421. One of the things with regards to, where your debt is concerned as well, in the market that we're in when it comes to mortgage, and really wanting to, if you find yourself in debt, and because the rates are so great right now, taking advantage of the equity that's in your home as well, refinancing, consolidating those debts.
Excellent.
Right.
Yes.
Yeah.
I'm glad you brought that up. Yes, that's an excellent point, because a lot of people, I keep hearing that, oh, I've paid down my mortgage now, I don't want to touch that. It's great to have it. But then meanwhile, they have, they're paying 20% in credit card debt, or 15% in automobile debt, or whatever, right? So always a good idea to refinance and pay the 2% or 3% or whatever it is that you have on the mortgage, and get rid of all those other debts, right?
Exactly. And just reposition and build yourself back up.
And I will add one more thing, because I am a realtor and I was investing. It's not just the cost that you're paying extra in interest. It's also the cost of lost savings, right? Because that money that you're paying to the credit card company is a waste. You could be putting it into the stock market. You could be putting it into an investment property. So now you're losing potentially even more. Right?
Exactly.
Of savings. So that's great. Excellent. So if you have any questions about credit or mortgages or anything like that, please contact Keisha. I'm sure she'll be happy to help. Excellent.
Yes.
Any parting words?
You know what? One thing I'll hashtag it. One of the things that I've been focused on during this whole COVID thing is coming out of COVID ahead and not behind.
Nice.
That is what's about right now.
Excellent. Excellent. I love that. Okay. That's great. Thanks again, Keisha. Have a wonderful day.
You're very welcome.
Talk again soon, I'm sure.
Thank you.
Bye-bye.